Good afternoon and welcome to our quarterly market update video. Today is Monday, January 25th. I hope this video finds you all well and having a good start to the new year. The purpose of the video is to give you some insight as to what's happening so far in this very short year that just started 4 weeks ago and some of the market drivers behind it. So I wanted to take a few minutes, review some things with you as to what's happening, and then discuss with you what we're doing to try to preserve and protect the portfolios as much as possible. First off, and this is something that most all of you know about, is the price of energy and oil and gas. It has come down. It's great for the consumer. It's very good for us when we go to the gas pump or fill up our home, heating oil tanks and buying natural gas. But at the same time, it's a big concern to the energy sector within the U.S. economy, whether it's the drillers, refineries, bulk carriers and transportation, equipment suppliers, and things of the like. A big portion of the U.S. economy is derived from the energy sector. And if there's a massive oil supply now and the demand is not what it was, the fear is that the earnings of these companies will come down significantly as the price of oil drops as well. So it is a concern. The oil and the commodities market has been very volatile. You don't have to look any further back than Friday. The price of crude oil was up 8% and the market did very well. Today, the price of crude oil is down just over 7%. And the market did not respond favorably. So there's a lot of volatility within that oil sector. So it remains to be seen if there will be some stability, and once the stability returns, at what price will it be? We're not ones to make predictions on the oil market. We'll leave that to the experts. But until there is some stability, I think you're going to continue to see the volatility, not just in that sector, but also in the financial markets as well. Another concern adding to the volatility for the markets this year is China. And while we don't invest directly in China, China is a very large emerging market and one where many U.S. companies are providing or exporting goods and services to that country. So China is growing at a very high growth rate, a rate that's higher than the United States. But at the same time, when they announce that they are slowing and their economy is slowing, it's a concern to the multinationals here, these U.S. companies that you know and you use and buy products from, because many of these companies, their overall profits and revenues come from about 40% derived overseas, with China being a big portion of that. So while China is still growing, they are an emerging market. Just look at the iPhone, Apple and the iPhone. If their China sales are slowing, that can come back and adversely affect Apple here as an American company. So there's news on this every day. We'll see how the reports come in, but that's a little bit of a concern, adding to the volatility within these U.S. markets. And again, we don't invest directly in China. Another item that's adding to this volatility to start this year is interest rates. Now, we've been talking about this for a while. The U.S. has had a 0% interest rate for a long time, and we had the first increase in December. One can argue whether or not it was needed, but they raised the interest rates a quarter of a point with the possibility of having more interest rate increases this year. Normally, when interest rates are increased, that's viewed as a positive for the economy. The economy is growing, the interest rate is using, or the Federal Reserve is using the interest rate to slow down and prevent inflation where necessary. But there are those who believe that the rates should not have been increased, and the only reason why they were is because they hadn't been increased in years. There'll be another Federal Reserve meeting this week with an announcement on Wednesday. We do not expect that they'll be raising again 2 days from now, but normally a quarter of a point is not really anything that'll hurt the economy. The problem is the uncertainty and the rhetoric that comes out of the Federal Reserve about raising or not raising. And again, it just adds to the volatility in the marketplace. Another concern is the U.S. economy slowing. Are profits slowing amongst corporate America? The interesting thing is a lot of these companies have their highest cash values that they've ever had, possibly because we're not hiring, or they're not hiring the way they were. They're not investing in capital infrastructure and technologies the way they were. So they're flush with cash, perhaps because they're not spending in view of a possible slowdown in their profits. So there's the concern about this. We try not to make predictions on these things, but we do look at our quantitative data that is based on facts. And what we do see is that certainly the market has slowed. Our indicators have gotten weaker. We saw this in December. We started to raise some cash in portfolios through the end of December, and then we had raised a lot of cash this year, January 11th, as our indicators continued to deteriorate. So what that means is we've gotten much more conservative in the portfolio. We've tried to take the risk assets down to a more suitable level. Risk assets, what we mean by that is the growth assets, the equities, the growth mutual funds, and certain investments we like when the economy is doing well. But we've had to reduce that risk and generate cash. So that's more of a conservative, protective move that we think is necessary at this time as we rely on our strategy and our quantitative information that we feel has been pretty accurate. So along those lines, we have raised cash. We have taken the exposure down to a comfortable level. We still have some investments, things in terms of core holdings that we believe in. Healthcare, for example, we have not sold that. We still think it's a great investment for today and the future. But we've taken some of those monies now and we've put them into bond positions, an overall bond index, some treasury notes, things of that nature that will provide at least a reasonable return on the cash that we have. So we're happy that we've done that. So far, it's proven to be a good move, and we will not rush into things. We will take our time and let our indicators tell us what we should be doing. At the same time, in these types of markets, very possible to have some very good days along with some very bad days. Just because you have a good day, that doesn't mean it's time that you should get back into the market. We need to let the fundamentals take place, let the stability return, and when it does, we will be in a very good position to move forward and reallocate the portfolio. So I just wanted to give you that update. As always, feel free to call me, to email me. We look forward to seeing you soon, but if you have any questions, contact us. We're happy to go over your specific situation in more detail. And of course, if you know someone who maybe we should talk to, give them a little further explanation as to what we see, by all means, pass along our name and number or have them contact us, and we'll be happy to speak to them on your behalf. Once again, we look forward to seeing you soon, and thank you for tuning in.